Okay, good morning, everybody.
Morning,
I
guys.
think it's time for us to kick off. Some people will still be logging on later on. We'll give them some time, but I think we can start off with the discussion. So today we're going to chat a little bit about disrupting trade credit and just sort of the agenda and who's joining me today. My name is Johan. I am the head of consulting, and we've got Louis Lombard here, who's our consulting executive. And we're going to have a little chat today regarding disrupting trade credit from external factors, from internal factors. And I think the agenda today is going to be, we're going to go through a couple of questions that we received from our clients, typical things they wanted us to touch on, some experiences we've had. And I think the main thing is sort of the interaction that we need from you guys. If we're discussing a topic and there's something you want to add, please raise your hand. We've got somebody controlling that, and you'll be able to join the discussion on a particular question or topic, your experiences. But it's a general discussion we want to have regarding things that we've noticed in the industry, and perhaps some things that we didn't all think about that you can share with us. Raise some questions if you've got them in the chat. We'll address those at the end. And then also, I think important for us from an Inoxico perspective is, sort of what are we doing to mitigate the things that are happening out in the industry? What are we doing sort of to disrupt, and how did we go about doing that? So we'll discuss that at a later end. So let's, I think, kick off and go through a couple of questions. If there are any that you want us to touch on in our opinion, please reach out. But I think let's kick off and start with the first question we've got here. So we received a question in terms of, obviously, what do you mean by disrupting trade credit? And I think, Louis, to that point, disrupting trade credit, in our opinion, is what companies are doing different in order to provide trade credit, and also, external factors to an extent that disrupted trade credit in terms of how people do business.
Yeah, I mean, if you think about it, the way companies do business has changed completely.
Yeah.
We've got the electronic medium that we use now. You can't just go and visit companies anymore.
Yeah.
And some of the laws and the stuff that has changed, and the effect that COVID brought about in terms of the way that we do business. So there's a lot of things that has changed over the last couple of years, which been disrupting the way that we do credit.
Yeah.
That we do business.
Yeah, I agree. I think, we don't want to hop on the fact of COVID, but unfortunately, when it comes to an event or something that has disrupted the way people provide credit and sort of do their mitigation and vetting process, COVID has had a massive impact on it. I know it's a couple of years ago, we're sort of out of that now, but previously when you needed to go and visit a client, you're getting a car and you drive there. Now, it's so easy to just say, well, let's hop on a Teams meeting. You can do so much more. So there are positive things. I suppose you can get a lot more done during the day from a meeting or interaction perspective. But the negative effect is that you don't have that personal touch with clients anymore, where you can sit across the table and say, look, are we going to do business? And sort of have that feel. I think it is important. And a lot of customers these days, fortunately, still do that, where they visit the client to see, does this client actually exist? Is it what it is? And it's important to do that just from a sort of ticking a box perspective, saying that, yes, this client says he wants to purchase this much. It is a massive organization. We've been there, we've seen it, we looked at the guy, as opposed to just, sending an application off to somebody, hoping it is legit, letting them complete it and sending it back. So I think the way we're doing business as because of a disruption and in the way we needed to do it, has had a massive change in terms of how people conduct business these days.
Especially, so again, as I said, I think that, where would we have thought that we would buy your groceries over the internet?
Yeah, no,
or you would get anything delivered basically at home, or the accessibility that we have in terms of to access information or to buy products.
Yeah.
The way that we communicate. Even this online meeting.
Yeah, online webinar,
working from home. So that stuff that didn't exist a couple of years ago.
Yeah, I think, a lot of companies were sort of forced to look towards the electronic medium to do their traditional business. Companies who previously didn't have a electronic application, it was paper-based. They were quickly forced to get that developed, get that rolled out in order to get it to a customer. Now you send an application off to somebody, they get it and they're working from home. If you think of the complexities of completing that application form, if you have to wet signature that application, you have to scan it back, you have to be able to print it. Not everybody's got those capabilities at home, unfortunately. So
Absolutely.
that disrupted business, and I think to an extent, largely trade, tremendously, just because the boxes that needed to be ticked from a sort of good corporate governance perspective of completing a credit application was not there. You could not do that because now you needed all these additional tools for printer, all of those, scanner, in order to just get an account approved. And that had a huge impact, I think, on trade. And to an extent, I think at level 5 or level 4, we were still able to get to the offices as sort of financial services, but we didn't see any trade happening. We saw nobody. And for an organization like ourselves, a fintech business, which is driven by data, we rely heavily on data. We rely heavily on trade. And if there's none of that, there's no trade, there's nothing happening. And I think a lot of customers felt that as well at, sort of a level 5 or level 4 event because they could not do business. So the disruption on trade was huge as an effect on that. But the good things from there that we learned probably is that companies are able to operate still if their employees are not at the office. They can be at home.
Absolutely. I think that was our biggest learning curve in the last 2 years, where we were able to say, we still have to work. We can't sit at home. So you're getting paid a salary every month. The company has to keep on making money, making sales, getting new customers, deliver products. And how would you do that? And I think by using the technology available, that's the biggest change we've had. In the
that was a huge disruption because I think to a large extent employers wanted to, I'm not saying have a hold of, but they wanted to see that the people are working from something's happening. And traditionally that only happened when you are at the office. When you're there, when you're sitting there, the boss is saying, okay, everybody's working, everybody's ticking over. And it was a huge mind shift, I think, for employers to have the same confidence in their people to say, everything is still going to happen, although I don't have line of sight of you, I can't see you. So they have to trust the employees working from home. They have to trust that everything's going to happen. And I think to a large extent, that went off seemingly. I mean, everybody did business, they continued where they needed to, and they work from home to the extent where a lot of companies are now saying, you can work from home if you want to a certain couple of days. And some companies are saying, you work from home 2 days and you at the office 3 days type thing. I know our organization had that exact same view and said, if you want to work from home completely and not at the office, you can do that as long as you sort of keep up with what you needed to do. And I think that is a huge plus, I think, for people out there, especially consumers, because and we'll touch on that later on. If you're thinking about the increases in inflation, increases in prices of a lot of consumables like fuel, for instance, and we'll touch on that. People don't have to drive to the office anymore. They don't have to sit in traffic for 2 hours to work for 8 hours. They can sit at home, they get on and do their thing. So I think in terms of disrupting, the biggest sort of event that have a multitude of effects on a lot of things is probably the COVID event. But I mean, that's over and done with now. And hopefully we out of that and we can get on with, I'm not saying traditional way of doing things, but a more effective way of doing things.
And also, I think the other big effect that it has from working from home was the how people react to it emotionally. Some people were fine working from home. Some people just couldn't work from home because they missed the interaction with their colleagues. It affected different people differently.
I think that sort of, I think that sort of is on the negative side where people were affected negatively because, if you're a type of person who needs that stimulation and that interaction, you don't have it. It's a massive impact.
Especially for a salesperson. Salespeople need to sit across one another and talk to one another. Now they have to do it over a computer.
It's not that easy. It's not that easy.
Scenario.
All right. Let's touch on the second question. And if there's anybody who wants to add onto that first sort of interaction, please feel free, just pop it through or Teams or raise your hand and we can have that discussion from your perspective and see how it affected yourself and your company perhaps. Right, the next question we got here is, what would you say is the biggest event that disrupted trade credit? But I think we touched on that in terms of, the COVID event and how it affected, the entire way of people doing business. And I think to an extent we've answered that question. So we'll go on to the next one here, which is...
Well, maybe if I can just add on in terms of that, is that, with COVID, there was a lot of So at the end of the day, in terms of South Africa, how we make money, it all depends on the consumer. So if there's no demand, people are not going to produce stuff. There's no activity that's going to take place.
Yeah.
So a lot of people had to take, because they were working from home, only the essential companies was working. So a lot of people had to take pay cuts. They were actually not getting paid. I mean, there were certain industries that was closed completely, and no work, no pay. So that I think had a big impact in terms of the consumer spending, and the earning capability of people, in terms of course they would do away with luxuries, and concentrate on the essentials.
Yeah.
Food.
100%. If the entire country is relying to a large extent on consumers buying and spending their money, and the consumers don't have that money, they're obviously going to start spending it on the essentials only and not on the luxuries. And, a luxury item would be you being able to drive your car, have fuel in the car and drive somewhere. If you didn't need to do that, which to a large extent people didn't, we didn't have to drive anymore. So, I think at one stage, the sort of Sasol oil price or share price went down to like 0 or just below.
Yeah.
So, that's an indication of we don't need to buy fuel anymore because we're not driving anymore. So we're happy to work from home. Positive and negatives, but to a large extent, I think business suffered because consumers didn't spend, and they didn't spend because they didn't want to. It's because they didn't have the cash.
But I think it was, so some of it is because the other portion of it is that they couldn't.
Yeah.
The restaurants were closed, liquor shops were closed, so all of that spending didn't take place, and there's but that industry still had to keep their staff, pay the rent, so there were still huge expenses incurred, but they were forced by government that they can't do business, and I think that had a huge impact as well on some of the.
Of course, I mean, if you think of the supply chain event, just by getting a plate of food on a restaurant table for a consumer, the logistics in terms of that, where it comes from, the farming of it, the FMCG part of it, the transportation of it, the prices, the cooking of it, and getting it on the plate and having a person sitting in that chair. It is a massive impact where it touches a lot of points where people perhaps don't consider the effect of what it had of a consumer not being able to buy something or spend money on something. And I think the effects of that is evident in companies not being able to sort of pay their bills, not being able to sort of be sustainable. And a lot of companies closed down. And we'll touch on a later stage in terms of the effect that it had in terms of sequestrations and liquidations and how that has panned out in the last couple of months. But it certainly had a massive impact on the spend because people just didn't have, and I think to a large extent today still, people don't have a lot of money as, disposable income to say, well, I'm going to go on a trip overseas or something like that. So, if you think about the sort of the leisure industry where people are traveling, the travel industry, that suffered a massive blow where huge companies were forced to sort of close down.
Absolutely. Yeah.
All right. Let's check on the next question here. We've got a question here. How did Papia affected the trade credit? So I think in that extent, something that has been happening in the last sort of couple of months is the effect of, I think, to business trade, the bank codes issue and the trade references issue. And I think, Papia had set out to do a lot of good, and it's sort of protecting the consumer and their type of information. But it spilled over to business where people are now saying, I don't want to give a trade reference because of Papia. I don't want to get a bank code because I don't have consent. And obviously companies still using those two elements had to make a change. That's a huge disruption in terms of the way they're thinking of providing credit. And, with respect, we are old school credit people. We've been in credit for a while. And I remember I didn't do any business as a credit manager if I didn't have that bank code or those trade references. It was absolutely essential. And I think to an extent, purely because at those days, we didn't have a lot of access to analytics, to data, to a magnitude of information and what is out there that you can use in order to do that. You sort of had, get the credit application, do a couple of checks, and you look the guy in the eye and you do business. That obviously has changed a lot.
Absolutely. I think, The benefit of that is that I think guys have actually realized that, what the real effect of trade references and bank codes were.
Yeah.
So what's the real value that you get out of that?
Of a trade reference, yeah.
Absolutely. So because guys always just give you a good trade, but they're not going to give you a bad.
Yeah, and I'm not going to say phone these guys. I pay them badly, phone them and get a reference. It's not going to happen. Yeah.
Yeah. And same with bank codes. A bank code. What does a bank code tell you? A bank code tells you whether that's the amount of money that comes into your bank account or goes out of your bank account within a specific period. So although it gives you sort of an indication of the guy's cash flow, but that's really where it ends.
Yeah, I think a lot of people and companies who come to us have asked us, how do we get over this bank code thing? How do we get over this sort of trade references thing? And our advice, I think, largely is always that if you're using bank codes or if you're using trade references as part of your decision-making process, treat it as part of your decision-making process. Don't treat it as the be-all and end-all. There's lots of other things and data analytics you've got available in order to get to that decision. If you don't have trade references, if you don't have a bank codes, there's a lot that you still have.
Absolutely.
Base your decision on what you have rather than what you don't. Because if you're going to base on what you don't, you're never going to give credit, because I'm always going to want something that I don't have. But there's still a lot that you can use. So people are slowly moving away from saying, bank codes are not important for us anymore. There's other avenues we can look at. Perhaps look at bank statements or something like that. Trade references are not important anymore. Let's rather see in some analytical data how a customer is behaving. And I think we'll touch at the end of how we have helped clients in sort of getting over that and what we've done in order to replace, that essential piece of information that clients used to have and that they still want to rely on.
And I think the other issue is that in terms of POPIA was protection of personal information. Yeah. So companies, so you can understand why it was brought in and what's the purpose of it, but companies got confused in terms of so how do I apply this? Yeah. What can I do? What can't I do? Can I now display? Can I tell somebody else that this guy's paying me badly, or he's paying me poorly, or he's paying me good? So all of that confusion cause another disruption in the way that we.
And I think to a large extent, it's because people don't know. They're rather afraid in telling something than doing the wrong thing. But, in my mind, if you give a factual depiction of how a customer pays you, that is fact. He hasn't paid me on time, or he has paid me on time. Rather than I'm scared to give it bad reasons because something might happen. So I think we need to perhaps just touch on that a little bit more. I think we've got a question from somebody here.
So the Ukraine war, what effect does it have on business and economy?
The Ukraine war. Okay, that's actually a question that we've got here. We're going to discuss that just now. So I think, do we do that right now, or I think let's test it now. So in the war in Ukraine and the effect that had on us, and we had a chat about that earlier on before this, in terms of what South Africa and Russia and Ukraine is doing. And South Africa imports mainly wheat and sunflower oils, so oils from Russia and Ukraine. And I think an average of about 1.8 million tons of wheat per calendar year and oil is imported. So that's a massive amount of imported consumables that we rely on in order to trade. And that obviously has disrupted largely to the effect where we don't do that. And what is the impact of that right now?
Yeah, if you think about cooking oil, every household in South Africa must be using cooking oil every day.
Yeah.
I think cooking oil prices increased by 50%, between 50 and 60% since the war started, just because of the wheat shortage that we
100%. And if you look at Russia, for instance, we import $506 million in the form of copper and wheat and oils. And also, petroleum oil. And to that extent, if you think about the discussion we just had earlier regarding getting a plate of food on a table, if the fuel prices are increased, which it has astronomically over the last couple of months, if you think of a plate of food that needs to arrive on a table, the transportation of getting livestock back and forth, that transportation cost has now increased. When that livestock is then moved over, that transportation cost is increased. Feeding of wheat and all of those things where animal feed is involved, that has increased. Getting that consumables worked into a format where it's absorbed by a consumer, is transportation costs. That's just one aspect. Transporting that entire sort of value chain or food chain to an acceptable form has increased tremendously. That's just the transportation cost. Now you're thinking of all the other things that are affected by that in terms of people being paid a salary. That has had to increase. Now people, you've seen we're probably in strike season now where a lot of people are saying we need more. And it's as a result of the external pressures and disruptions that are put on us. And it's not something that we've got control over. The oil price increased dramatically. I think at one stage it was at $50. It went up to $75, where we sort of hovered on. And from 75 is now sitting like at 110, 113. So the price has increased tremendously in terms of fuel. And if you think of your product that you've got in your organization, that product is taken somewhere to be sold by a transport company, either your own or a contractor. That has increased tremendously. So those costs have come up, which means that the production of your product has increased. That means that you need to sell it for more or either cut your margins.
Yeah, so I mean, again, this is a vicious circle. So what happens now is that those costs gets passed on to the consumer. That means that inflation is going up. That means that interest rates is going up. And that means at the end of the day that the consumer's got less money in his pocket.
Yeah.
So by the rate that inflation and all these costs are increasing, we can't increase salaries by the same
Margin
extent or margins.
Yeah.
And that's what's causing. That's why the consumer in South Africa are so much in debt, because they have to live on loans, extra
Borrowing
bonds.
money. Yeah. And to that extent, you're right. If you think of a lot of people in South Africa, unfortunately, are living on borrowed money, either from a credit card or either from a loan or facility. And to a large extent, companies are also servicing debt, whether it's either through a bank overdraft or through a loan that they've got. If the inflation goes up, which it is, then the interest rates are going to be pushed up. If the interest rate goes pushed up, it means that you're paying more on servicing those bonds and loans, which means you've got less disposable income, which means you need to increase your prices. And that knock-on effect in the end is going to sit with the consumer, which in this state has got less buying power because they're not having that disposable income. So it just means that we're probably going to have to think and do smarter things of getting your products to the consumers at an affordable rate or at an affordable measure, because your margins are being squeezed because of inflation. Your margins are being squeezed because of external factors like the Ukraine war, where fuel prices and everything are pushed up. Because all of that is squeezed, you now are forced to sell your goods at a higher price, which the consumers are not going to want to absorb because they've got less cash to start off with. So getting it over there is going to be a problem.
Yeah, so from a consumer point of view, is that I think where the trick lies is that if you're going to spend a rand, where am I going to spend this rand? Where am I going to get the most value out of this rand?
Bang for my buck. Yeah,
exactly. Because you need to turn over every rand and cent in order to make your budget balance at the end of the month.
Some people don't even have budgets, and that's a problem. You have to kick the budget out. Yeah, so I think from a Ukraine war perspective, the fact that we import a lot of those things is costing us more to import it, and because we are now paying more for that imports, the price that we're getting sold to the consumer's going to have to pay more for it. Somewhere, if we import all of these things that we're consuming, and we are at the gate paying more for it to get here, we're going to have to just see price increases, I think, for the next couple of months on all of those things that we touch, that we import, like, the fuels, the wheat, the grain, and all of those type of things. I mean, Ukraine and Russia is a huge exporter of those things to us, and we consume it at large volumes, and it is going to have a knock-on effect in the next couple of months still on everything, not just the consumers, but business in a large extent as well.
Right, and they predict that interest rates, we're going to have 2 more interest rates just before the end of the year.
2 more interest rate hikes. Yeah, I mean, if you see interest rate hikes, you cringe, because if you've got a loan of any sort, whether it's a car, a bond, or whatever, from a consumer perspective, it's a huge effect on you. If you tell you what that 1% or half a basis point is affecting you, and then you're looking at businesses who are servicing loans, who are servicing overdraft facilities, it's got a direct effect on those as well.
Absolutely.
So all of a sudden you pay more for everything from the gate, and you have to pass those costs on if you still want to remain profitable, if you still want to remain trading and in business. So I think the direct effect that's going to have on businesses is that they're going to make less profit if they're going to want to still trade, because there's no ways that the consumer at the end, whoever that consumer is going to want to pay more for the same product just because your production cost is higher. It's gonna have an impact, I think.
Absolutely.
Less trade is probably going to have done. I don't know if you guys have any thoughts on those. If anybody wants to reach out and tell us what your thoughts on those are, but I mean that's I think what we're seeing from our perspective. All right, I think let's get to the next one, and this is a good one. How did the disrupting of trade credit influence credit insurance industries? So I want to start off by saying, and I work for a credit insurer, so if you can afford credit insurance, absolutely take it, because you're going to sleep a lot better. You're going to know that in worst case scenario, you'll probably get 80% of that back. You'll be able to cover your production costs, and that perhaps not your margin. So if you can afford credit insurance, take it, keep it, and run with it. The problem, however, and the concern, however, is that we are seeing from our perspective, a lot of the clients who do have insurance come to us and ask us if there are alternatives in terms of managing their risk of their debtors. Because, and I think you can concur because you've been in that industry for a bit, insurance is becoming expensive. Insurance companies are not necessarily have appetite to insure certain customers or certain industries even. I mean, what do you think on those points? So you've been there, I think.
Again, so I've been with COVID, the insurance companies anticipated that they're gonna get hit by huge claims, and they're gonna end up with huge losses. So in order to mitigate that, they started to increase insurance percentages. They introduced aggregates on the policies. They refused to issue limits on certain industries, like for instance the restaurant industry. You know, you just couldn't get cover anymore in the restaurant industry. There was huge outstandings at that time. The liquor industry, it was a problem. So the cost of credit became expensive.
Insuring it,
So in other words, to get into insurance costs. So the knock-on effect of that was a lot of companies don't do business unless they get insurance on a particular debtor if they want to sell to.
Sure.
So that had a huge knock-on effect in terms of the capabilities of companies to sell to whoever they want to, or whatever level that they should do.
Yeah. I think if you're in a fortunate position to have credit insurance and get to a stance where you're saying we're not going to supply any goods or services if we don't get insurance on it, that's great if that's your business model. I just think that because credit insurance companies are increasing premiums and are steering away from certain industries or certain sort of companies, it might be to where, and we see that now where customers are coming to us and say, I've got credit insurance, it works well for me, these are my brokers, we love all of that, but we can't grow. There's not that growth element that we're looking for because we are restricted because of this. And in my mind, a credit insurance policy should not restrict your trade. It should enhance your trade. It should give you more capabilities to go out and get more business because you've got that insurance. The fact of the matter is that if the insurance companies do not want to insure their debtor, that's fine. If they don't want to insure an industry, that's fine. But companies are saying to us that, yes, I've got insurance, and I don't always get the facility that I'm asking or the limit that I'm asking from the insurance company. What else is there that I can use to mitigate that risk? And I think that's where companies like ourselves are perhaps in a fortunate position where we do have some tools that are able to service the customers.
The other problem that companies run into is that they would like to cancel the insurance because it's just not, they can't afford it anymore. But the issue that they have is that who's going to do their vetting? Who's going to mark their limits? You know, it was easy. They just, a customer apply for 50,000 and send it to the insurance company. And the insurance company come back and say, yeah or no.
I think that's a question that we ask all the clients when they want to sort of move over to alternative sources of information, is that, have you got the in-house capabilities? Have you got the actual expertise to manage this book internally? Because to a large extent, you're right. The companies were just saying, well, I'm going to send it over to somebody else. They'll tell me yes or no. There's no sort of following your own due diligence in terms of getting that vetting process done, understanding the information and saying, am I going to do this? If that old school credit manager who used to be in the business are saying, yeah, I want to do this business based on these reasons. That's not there. And for them now to say, I want to do away with credit insurance means that I need to take all of that in-house. I need to look at all of that information in-house and get to a decision. And as you're saying, they don't necessarily have the skill set to do that, currently.
Absolutely, yeah. So I think that's, you know, that's one of the changes in the market.
Disrupting, yeah.
Absolutely.
Yeah. And if people are going to want to move away from insurance, it is a huge move, because if I've been doing business a certain way with insurance, you're comfortable with that. You know that you're going to sleep well because you're able to get some comfort in the fact that if this debtor defaults, I'll get some money back.
80% of my
Now, to think of, not only do I need to internally assess that risk, I also stand the chance of losing this entire product or deal or value is a huge mind shift change. And that's all as a result, as I said, right in the beginning, of what disrupted trade credit. And it started off with how COVID affected everything and knock-on effects of that, you know, the price increases, everything else that forced people to increase their service or their product is now having an effect on how people do business.
And also, I mean, because margins are so stretched at the moment, you know, because of COVID, a lot of guys are saying that, you know, I'm paying this premium every year, but my claims is not even 10% of that.
Yeah, what am I getting for it?
What am I getting for it? So
Yeah.
can't I rather take that money, put it somewhere else, and then do a self-insurance type of
Self-insure,
thing? But the issue is then is that they don't have systems in place to actually do proper vetting.
Internally, that's where the problem comes in, because I now need to assess this, and where somebody else used to do it for me.
That's it. Yeah.
I always used to say that when you do have credit insurance, always ensure that no matter what the insurance company says, you at the end are still comfortable and happy with doing the business.
Whether you want to take that risk or not.
Exactly. Whether you want to take
But you're still in for 20%.
Exactly. You're gonna have an 80% insurance
whatever
percentage, or
percentage.
yeah, but you're still gonna take a knock. But what I'm trying to say is that ensure that no matter what outside sources tell you about a recommendation, about a facility, about insurance, ensure that you're happy with it. Because you, in the end, that's the guy who's going to lose the money or not. You're the end that's going to make the profit or not. The insurance company is not going to say, well, you know, give us part of the profit or we're washing our hands. You're the guy that's taking the risk. You're the guy that needs to be happy, irrespective of whatever outsourced piece of information you get, because you need to do that vetting process, right?
Because at the end of the day, even if you do put in a claim, you don't want to wait 6 months before you get your money.
Exactly. If you,
So
some
the cost
people
of
can't
capital,
afford. Yeah,
absolutely.
yeah.
You know, so you have to take all those things. You have to have a proper system in place in terms of how do I do my vetting? What are the things I look at in order to, so I suppose if you've got 10 Rand to spend on debtors, you know, you want to know, where should I spend this 10 Rand? Should I spend it on the good guys, or should I spend it on the bad guys? And a lot of the customers don't always know, you know, which are the good customers, which are the bad customers.
Sure. And I think to a large extent, in terms of disrupting trade credit, that's where I think our company, Noxico, has taken a big leap in terms of trying to help customers with that. And I think we'll touch on that in the end of how we are able to sort of guide them in those sort of directions. But you're 100%, you know, if I've got a customer that pays me well and I've got no problems with, versus going to look for a new customer where there might be a risk, where there might be things, where there's an unknown, I'd rather spend it with the customer who's paying me well and sell more to him, you know, rather than venture out into the wild. If you don't have insurance, or if you don't have proper systems in place to spend that 10 Rand somewhere else, it's not going to be, it's too risky, I think, in my opinion, these days.
Absolutely.
Yeah. All right, I think that covers that one in terms of credit insurance. And yeah, I mean, we've got a lot of customers who do have credit insurance from an Noxico perspective, and they use us and they use the credit insurance to a large extent very well. It works well together. And as I said, if you can afford credit insurance, take it. It's definitely the better thing to have if you can afford it. So the next question we've got here is extended payment terms and the knock-on effect it has on suppliers. I think we've touched on that, but what we've seen is that customers are paying slower and slower as a result of initially being given extended terms. So I sign a contract with you, I need to pay in 30 days, a huge event happens, a COVID event happens. Now, you want to get rid of your product. You want to sell it to me, and I'm saying, I can't pay on 30 days, I can only pay you on 90 days. And you're saying, well, that's fine. You know, I need to get rid of this product. I'm going to sell it to you, pay me in 90 days. So that allowed sort of the people, the debtors, to pay slower and slower, purely because it was allowed in the beginning. And nobody wants to revert back and say, well, although you've been giving me 90-day terms for the last 6 months, I now want to start paying you on 30-day terms. If you're able to, great, because perhaps you can negotiate some discounts, but people are paying slower and slower. And I think to that extent, when we're looking at sort of a South African contingent, we rank 43rd in the world in place of complexities of collection cash. And that relates to our average debtor paying 90 days as opposed to the sort of global standard of 30 or 60 days on trade credit. So that says a lot, 43rd in terms of where we rank in terms of the complexity of collecting, which means there's a lot of hoops you need to jump through just to get the cash that you are owed, which is a problem.
But I think, COVID had a lot to do with that, because customers didn't actually have an option.
Yeah.
You were either giving the guy extended terms, let him help him to trade out of the problem in order for you to get your money. If you said, no, I'm not going to give you extended terms, you need to pay me on that, they most probably would have lost all that money, and a lot more businesses would have closed down.
Yeah.
So a lot of it was forced in order just to protect themselves, to recover some of their money.
Sure.
Yeah. So they had to offer the guy some sort of a bridging finance to say, all right, we will help you over the next 9 months or 10 months or whatever the case may be.
And I think it's very difficult for a supplier to understand if a buyer is paying everybody slow, or whether he's just paying me slow because I'm allowing him to pay slow, or what is the situation? Because if I've allowed a buyer to pay me at 90 days because I wanted to help him trade out of this, or the net effect is, if I said no, as you said, the customer would have closed down. I can't pay you, you apply for liquidation, whatever the case is, and they close the business down. And that's not the effect. You want to keep that debtor, and you want that debtor retained, but he is paying you slower. So if we think back of our earlier conversation, the cost of production at the gate to get your product out there. Now you've got a customer and you negotiate with this customer saying, I'm going to sell this to you on 30-day terms. And in your mind, all the production and operational costs you had to forego in order to get this product to this client. Selling it to him at 30 days is going to give you a certain margin, right? And you bank on that margin in order to recover your costs, in order to service your loans, in order to pay your bills. That margin is what you need to make. If that margin on 30 days is now extended to 60 days, to 90 days, it probably eats up 1% of your margin at every 30 days. And now you're looking at a lesser margin for the same product that you produced, but the guy's just paying you slower. Now, in my mind, what I'm going to do is I'm going to want to go and look for other companies who are going to be able to pay me at 30 days.
Absolutely.
And then we're sitting with that same scenario again. Where would you spend that $10? That's somebody that you know is going to pay you, or venture off and try and find somebody out there who's going to pay you on time. It's a difficult scenario.
Yeah, and if you haven't got the systems and the processes in place in order to do that, it's a difficult decision to make.
Absolutely, yeah. It's a problem. We've got a question from somebody.
2 questions.
Yeah.
So the first one is, would you recommend a focus on retention of clients with the credit policy, structure around data review and monitoring, or continue the sales push to gain new business? What are the risks in both these strategies?
Okay, so I think on the first one, in terms of retention, organic growth is something that is absolutely necessary. And it is difficult to say, let's not go out and get new customers. The customers that you do have already, it is important to focus on the clients that pay you well, where you can make those margins. And there will always be a mixture of those. There will be a 30-day customer who's a fantastic 45-day customer. He pays you spot on 45 days every single time. You offer him 60 days, he doesn't want it. He's a good 45-day customer. The margins you're going to make on that is the margins you're going to make. So the advice, I think, when we talk to clients about that and looking at the debtors books, and we look at a lot, I mean, we get a magnitude of information through our organization. There are customers who pay on 45 days. There are customers who pay on 30 days spot on. The advice would be that in organic growth, there is already that process that you've gone through in terms of finding a customer, which is not easy. You've vetted that customer already. You already have a relationship with that customer. Somebody in your organization is already handling that client. It makes sense to drive organic growth, especially these days. To drive organic growth to ensure you get to your growth potential, whatever that is, 10 or 20%. It's already a client of yours. That client who is paying you well is buying from other people because he's got the luxury to have an account with lots of people because he's a good payer. If you pay well, you can have lots of accounts. So customer service, first of all, and the maintenance of that account in terms of constant contact and engagement with a client, to be on top of his needs, to be on top of his requirements is essential because, as I say, that client can buy from anywhere. The fact that you are there in his door, punting your product, servicing the client, making sure he's happy, is going to get you that order. He's not going to go somewhere else.
Well, and it's not only pricing that always plays a
No,
role.
no, not
It's
at all.
service, it's quality, all of those type of things so then you have to go to the add-ons, the value adds that the customer
Exactly, yeah.
from you that he couldn't get from the next supplier.
Exactly. I don't know these days if customers still offer sort of settlement discounts, but I mean, there's lots of different ways you can entice a customer to spend more with you if it is a good customer. And to start off this whole conversation, I think it is important to find out and establish if it is actually a good customer. And I say that because if the debtor is paying you well and he's on time every single month, that does not necessarily relate to the fact that he's paying everybody else well, that everybody else is happy with him. You might be the major supplier to this customer. That's why he pays you well, but he's defaulting everywhere else. The problem with that is, and I think our audience has seen that, is that how can this customer not pay me at month end? What happened? All of a sudden he's not paying. Where did this come from? But the warning signs were there that you did not see. And you didn't see it because he's always been paying you on time. You need to have that line of sight of how a customer of yours is behaving holistically, not just with you. And I think to a large extent, that is something that we help clients with tremendously these days. We'll touch on that later. But you need to have a holistic view of that customer, not just with you, but with everybody, to ensure that he is a good customer. Spend more with that client. Absolutely. There are good 45-day customers. Target those guys as well. You know he's going to pay you at 45 days. You can push up the margins. You can push the price. You will make money on him. So organic growth, absolutely do that. The problem with that is that it is only sustainable for that long. Then you need to get new customers on board, because there is a churn and you will lose some customers off the back end that you perhaps don't want to do business with more, or perhaps buying from somebody else. You need to get new business in. And I think the same applies to targeting or getting the salespeople to go and get new business. Everybody's got a sales policy, and the sales policy says and dictates, this is the mandates, this is what we do, this is how we do it, and what information we get. Stick to that. When it comes to new business, you need that dynamic sales team out there who's going to get out there. And I think today, more than any other time, that salespeople need to get out to the customer. A couple of months ago, we weren't allowed to do that. You can't go to the customer. Get that salespeople out to the clients, talk to them, look at them, shake their hand. People miss that. To your point early on, people got depressed by just sitting at home, not being able to have that. And it's a lot of salespeople.
Yeah, absolutely. I mean, they need to have that personal interaction with people, which we didn't have for a long time. It's now slowly coming back. I mean, one of the stats that we looked on earlier is to say that the growth in the GDP, we now just about back where we were prior to COVID 3 years ago.
Yeah.
So we've managed to catch up, but we've lost 3 years.
Exactly. Yeah. And to that extent, salespeople need to get out there. We had a customer the other day when we wanted to organize a meeting, and he said, we don't do Teams meetings anymore. You must come out to our office. And that is so refreshing, because people still want to do business with people. That's where I think the value in terms of doing business has been disrupted tremendously, because people want to do business with people, but you weren't able to get to that person. You need to look at him over a screen, which is not the same effect. So get your salespeople to go out and have a look and meet the company. The problem you will face, however, is that you won't know as a salesperson when you're going out to see a company whether that company holistically is actually paying well, whether it's a good debtor, whether I want to do business with them. Salespeople, they want to target everything. They want to get everything in. They want everything approved. It does not necessarily work like that. So I almost want to say that before a salesperson gets out to a company, you need to sort of have that salesperson armed with some information to say, it is a great company. Yes, go and do business with them. And I think, on that point, we on our side has got a fantastic tool to help salespeople do exactly that. So that will be able to give them the information to say, let's target this business because holistically it is good and we need to do business with that client.
Yeah. One more question. How to maintain and control debtors with overall exposures below trade credit insurance threshold?
Okay, so in terms of maintenance for debtors below the insurance threshold, and I'm assuming we're referring to either limited discretions or franchise losses or first losses or AGs. Those type of things are where you need to be able to manage that risk, because nobody else is going to do it. You've set on the deal. Yes, the insurance company will cover it in the event of a protracted default, but you need to manage that customer. You need to grow that customer to the extent where he's a big customer. in order to manage and maintain those customers, again, it is important to have line of sight of a holistic view of that customer. The credit insurance companies are not going to do that for you. The credit insurance company is either going to pay out your claim or repudiate your claim. That's their role.
Yeah, the insurance company is going to tell you when there's a problem.
Yeah.
You know, so you need to have processes or procedures in place where you can monitor those guys and look out for the warning signs.
Yeah.
You know, if the yellow lights are coming on, you know, you need to decide, okay, what am I going to do here? You know, put the guy on stop supply, get
Exactly.
securities.
Yeah. The problem is, where do you get those yellow lights from? Where do you get those warning lights from? And this is exactly to our point, that if you have credit insurance, you're going to get a paid out claim or you're going to claim repudiated. That is their role. That is their job. The function of maintenance, the function of managing that data always resides with you. You need to ensure that the initial risk you took on of a customer, whether it's in excess or below the actual restraints of the insurance policy, you are responsible to manage the customer. You need to have a view of that customer. You need to monitor that customer. You need to ensure that your salespeople get out there every now and then and see that this guy is still trading. A lot is said for a salesperson walking into a factory and the factory is buzzing and things are happening. You can see the guys doing business. When you walk into a factory and there's no workers and they're on half a day and only one machine is running, you know there are problems. So get out there, even on the customers that are under that sort of prescribed procedures of the policy. Get out there and make sure, if you don't have salespeople who are able to get out there, make sure that you've got a sort of service provider that can give you that information, that monitors that data for you. And there's a lot of them out there who says, we can monitor the data for you. But the problem is that you need to ensure that the initial risk you took on for that customer is still the same. And not only that, if it is good, you want to target and grow that customer. So you need information, you need analytics, you need data.
But I think also what's important is that, you know, because this falls below the insurance threshold.
Yeah.
So it's normally small amounts. So the credit controllers tends to ignore the small companies and only focus on the big companies.
I agree.
And I think that's where the problem comes in, is that because if nobody pays me for my money, then, you know, I'm going to pay you when I want to.
100%.
You know, so unless there's that constant contact from a credit controller with the customer, understands the customer, knows what's going on, put the pressure on the, you know, you're not going to get paid.
Yeah. But here's the kicker though. In a lot of businesses, they consider that to be, it's a small amount. We're not really considered, but a small amount is relative to your book and relative to your industry. But look at the number of debtors in terms of value that represents that small amount. And then look at, if you were to lose half of that, what impact would that have on your business? All of a sudden, that's a big figure. All of a sudden, that's going to make a material effect on your business. Therefore, I agree, the bigger customers are there. We all need to manage them. But the smaller ones are where the nuggets are, where you can actually grow that customer to be a big customer. Because initial order might just be small because you needed something quickly that somebody else could not supply. Now, all of a sudden, you can. So the smaller customers, grow them, maintain them, ensure that you've got sufficient information daily or weekly to see, is the risk changing on this customer? Do I have to do something? The warning signs is what you want to see. You don't want to have insurance and say, well, the insurance company tells me something is wrong. It's too late then. I don't want something to go wrong. I need my product backed before that sort of customer goes down. I don't want to go through, you know, sort of claim process and wait 6 months to get it. I need those warning signs right up front.
Absolutely.
Okay. Does that answer the question? I'm hoping.
Yes.
All right.
So I think we need to.
I think just to the last point, you know, we wanted to mention that companies have, to a large extent, said that I don't need information on the big companies. I don't need information or insurance on the blue chip companies. They're always going to be there. They're always going to pay. And I think just on our last point is that we've seen recently the likes of, you know, Comair, Revlon, Edcon, SAA, SA Express, all of those huge organizations go under. And if the warning signs were there and people ignore them because they're a big company and, you know, they're always going to be there, I think that's a lesson in all of us. You know, if there are warning signs, whether it's big or small, have a look at it. Look at it in relation to your business. What is it going to be? And we're talking about hundreds of millions of rands here that got lost from consumers on the Comair, where I booked a flight, right through to, you know, Edcon and everybody else. If we're looking at Revlon that went under, a lot of people didn't wear makeup, you know. If you think of the ladies who wore makeup, everybody wore a mask for 2 years. They didn't sell any lipstick. Those type of things has a knock-on effect, has a huge sort of disruption in terms of how people did business and what they purchased from a consumer perspective. And, you know, to our point, have a look at the big ones, make sure that you're comfortable with that risk, as well as the smaller ones that are perhaps below the threshold of the insurance companies.
Yeah, I think the point is just, treat all your debtors the same.
Yeah.
So whatever you do, make sure that from whether it's from a credit control point of view, whether it's from a sales point of view, that you actually know your client, you know what's going on there,
100%.
you know what drives their business.
Yeah.
And you know what role you play in terms of their supply chain.
Exactly. I think to that point, if you think of a credit policy, the credit policy doesn't state you treat customers differently because of the size. It states treat them differently because of the size and have more information and have more things on the bigger ones, not less. And people tend to move that around and saying, I don't need all of this information on the bigger ones because, it's a big company. You should have more information, more interaction, everything more on these companies. So I think to conclude, we're going to chat about the things during what we've mentioned now, and Inoxico to a large extent has sort of disrupted trade credit as well. And I think a lot of people on call here will know that in terms of how we do business, how we are able to help clients get over the fact that you don't need a bank code anymore, that you don't need trade reference anymore. We've got bank statement analytics that provides a code. We have got payment profile information in lieu of trade references. So our product gives you line of sight of all of your customers, and not just that, we tell you every single day on every single customer of all the data we have got and that we've analyzed, which customers you should grow, which customers there are warning signs on. We monitor it on a daily basis, and we ensure to the questions we had earlier on, where do you grow your customers? We tell you where you grow your customers. We not only tell you where you grow customers, we actively look at all the data we've got on your customer, how he pays everybody else, and we make a recommendation on a daily basis of what we think that facility should be. We monitor that facility and we ensure that the risk is in your face of that data every single day. Gives you the growth opportunities, gives you those yellow warning signs on the big customers and on the smaller customers. Even if you do have an insurance policy, all of the customers use our product in order to grow. Where organically can I grow? And again, to the new customers that you want to bring on board, your salespeople bring it on board. We have automated that entire process where people don't need a wet signature. It's a one-time PIN. We've automated the process of getting the application to your customer and back, digitized that entire process. And when you get that application back, the first thing you'll see is a recommendation from us. This is what we think. So we are disrupting, if I can use that word, the trade sort of credit industry. We're no longer saying to our clients, come to us and ask us for information if you need anything. We are saying, we're going to give you all of the information we have on all of your customers every single day. And not only that, we will make a recommendation for you on that facility as well. And I think that, to a large extent, encompasses and answers a lot of the questions that we've got faced here in terms of how do we go forward with this.
And I think the biggest difference is that traditional credit management was about always backwards looking, so look how the guy behaved in the past, and then based on that and some gut feel and some experience, you would then say, right, I think I'm going to give this guy credit, he will pay me.
Absolutely.
Where the difference is that in terms of the models and the analytics that we've built, taking all of this information that we have, statutory information,
SIPC, the SARS information,
all of that, SARS information, payment information, all that, and we're able to give you a prediction forward in terms of whether that guy, what's the possibility of him paying you in the future and within terms.
On time, yeah. So it's a forward-looking picture of the data using, historical information and what we think that data is going to do based on his holistic view and behavior. I think is what's important. All right, I think that's us for today. We've talked a lot. I need to have some coffee now. Thank you, Louis, for joining us today, and for everybody else setting us up. We are going to have some questions. If you want to field them on here, we'll be able to answer them. We'll post a link on here as well if you want to get hold of us to discuss some of the options or alternatives you need. And we'll have one of these, I think, every couple of weeks. So please log on and let's have a chat. It's nice to have the audience post some questions. Once we've off on this, if you have further questions, get hold of us. We're happy to engage. But I think from our side, spot on and on an hour, that's us.
Yeah, Quinn, if you want to know more or see more in terms of what we do here in Oxyco, in terms of our product, the new platform, please feel free to contact us.
Yeah.
And we will take
Reach out. Thank you so much. Have a good day and good luck out there.